that she tells me, but hey, I will definitely subscribe to that technology. They did also say they're still building pretty substantially in AI, although pretty broad strokes. Safe to say that Andy Jassy was not as enthusiastic about some of the commentary of like if they're falling behind in AI. So that was a bit of a concern to me. I will say the overall tone of the call was, and the report was still positive, but there was just some times he answered where I was like, that is where I would have been overly enthusiastic.
Yeah, maybe he's still just getting kind of used to running the show a little bit. I'm not going to criticize that too much, but a lot of the same things when it comes to valuation apply here. 26 times forward earnings, the 5-year average closer to 23.5. Pre-2023. 24, 25 would have been the high end of the range for a forward earnings valuation. So still would be quite elevated at these levels. But I think to me, the biggest takeaway by far was not just the disappointing growth in AWS, and that was of course in direct comparison to Microsoft. Actually, interestingly, yesterday's reaction was lower Amazon, and then Microsoft actually saw a rally post Amazon's earnings. I think it made Microsoft even look better. But the margins plunged as well, lowest in like a year and a half for the AWS segment. And that's concerning because it's like, okay, normally you'd be taking a little bit of a margin hit to spur growth, but you didn't really see growth outperform, yet you took the margin hit. So, cloud side of the business, it's okay. Nothing, super exciting, especially relative to Microsoft, but I thought the e-commerce side was largely pretty good.
Yeah, I would say definitely largely pretty, still a massive company. And they also did, again, really, well, I would say the tone wasn't great. There were still definitely numbers matter more. And so, you could change the narrative all you want as far as like leadership goes, but there was still really strong numbers from this company. And again, there's still a massive player in e-commerce, AWS, and expanding on their AI offerings. So all these companies, I think, have shown the appetite for spend has definitely not dissipated at all, frankly. Shifting gears, though, now looking at Reddit, which saw blowout results for their second quarter. Daily active users topped expectations for the second straight quarter, growing 21% year over year to around 110 million versus the 109 million estimated. International daily active users, though, rose 32%. U.S. daily active users were up 11%. And the company did report net income that improved 45 cents a share from a loss of 6 cents a share just a year ago. And revenue climbed a whopping 78%. So, yeah, stellar report, as you can see, from a 21% jump today.
Yeah, the big story to me was average revenue per user, way better than expected, $4.50. Expectation was closer to $3.90, so huge win there. And if your users just hit the mark, but you make almost 10-15% more than you thought you were going to per user, pretty easy story to digest when we think about it. I think this is about the most straightforward result as you could have figured.
Yeah, I would say as well. And our last name today is also pretty straightforward. Coinbase could not have had pretty much a worse earnings report if they tried. I've never seen a company that missed the mark so badly. There is some good things.
This is a good point because I also think that it highlights the concerns that people thought, and economists and investors and analysts started to feel around Coinbase, which is there's a lot of places you can go to now to get exposure to digital assets. And when you were essentially the only game in town, not only were you seen as a proxy for the space in the equity market, but you didn't have a lot of competitors to fight with people who wanted direct access to them. Now you got exchange traded funds, you got companies like Strategy, you've got tons of traditional financial services companies that are offering this. You have places like PayPal and Block that are offering things like this. Like Coinbase, yeah, they're maturing and their numbers are okay-ish, but they're not the only game in town. It's showing really, really, quickly, how disappointing that can be when you underperform.
And I think that with all of the positive news we've gotten from like legislation, the Trump administration has been definitely a friend to crypto. This report is a little confusing. Yeah, transaction revenue was down from a year ago. You had adjusted earnings at 12 cents a share. Incomparable to $1.10 last year. Retail transaction revenue declined. Institutional transaction revenue fell short of estimates. Subscription and services revenue did actually rise, but didn't meet expectations. Stablecoin revenue also missed expectations, and total trading volumes might be the only bright spot. That was up 5% from last year. but down from last quarter. So
well, it all missed expectations.
Everything missed expectations. I'm surprised we're not down more. I mean, we see names get punished for far less.
I mean, they're down 16%. That's a big move.
That's true. I guess I'm getting greedy. I'm used to the days of like Snap.
You wanted carnage.
I know. I'm used to the time like when Netflix like plummeted like 40% on the session. That is the volatility I like to see.
You can count those days on like one hand.
That's
There's
true.
been a couple Facebook days like that. Certainly Netflix and I mean Snap's not in that caliber in terms of company, but Coinbase might be though.
I know, and I guess just again, given all of the favorability we've seen in crypto, it goes to show that competition is clearly eating away at that dominance they once had, as they were somewhat the only player in town that offered, I mean, the extent of crypto trading that they did. So really bad miss across the board. I'd say it's 16% move to the downside. Almost feels like a relief. We'll leave it there, though, for the top of our show. Now, coming up next, we'll look at the latest technical levels in Netflix and Tesla, as well as look at some example trades in both those names.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our Investing Webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Gen Investing. It's now time to look at the technicals in two names that we discuss pretty often, those being Netflix as well as Tesla. Two actually non-earnings movers this week, because you already got those numbers, of course, previously. But joining us now is our chart master today, Kevin Horner. Kevin, we'll start things off with Netflix. Thank you so much for joining us today. Netflix was higher, now erasing some of that strength with the overall market. Really sell-off we're starting to see pick up here. So what are you seeing as far as the technical front of Netflix?
Yeah, been a good year, obviously. Year to date, the stock's still up 28%. You can see it on the daily chart. We'll see in a second here. A beautiful uptrend, lower left to upper right, precisely what you're looking for. But we're sitting on a zone of short-term support as we speak, right around $1,160 a share after pulling back a bit here in the last month plus. We can also note, as I've called out with the oval here, the 20-day moving average in orange, downward sloping through the 50-day in purple, giving us a bit of an indication of a potential shorter to intermediate term trend shift here. And I think traders need to be aware of it. You'll notice that, as you said, the sell-off is kind of intensifying broadly in the market, and Netflix is seeming to participate as well. So we're going to see that 1160 need to hold here real quick. If not, we could certainly get a little bit of a momentum-based sell-off opportunity here in the near term.
Yeah, and so as far as now, if we zoom in here and look at, I mean, the recent trends in Netflix, which is still, again, been pretty strong, but closing out July on a bit more of a weaker note, and some of this week's activity also a bit weaker after what was, I mean, a banner a few months for Netflix. What else are you seeing as far as the short term?
Well, traders tend to try and drill into these shorter term windows and utilize alternate time frames to help them pinpoint entry and exit signals. And one of the things I've done on this chart is to change the time frame and incorporate some very basic simple moving averages that are consistent with the 10, the 20, and 50-day moving averages on a daily look. That purple downslope that we see at 1181 is representative of the 10-day moving average, essentially. And so some traders can look at the hourly chart over the last 30 days and just fine-tune their view. As you'll note, we're pretty much stuck in this $28 to $30 range over the last about week and a half or so. And if we break that, then of course, Technical Analysis 101 suggests if you break the range one way or the other, then you take the height of that range and you can target the next area. Well, here you've got about a $30 range, maybe 1,030 on a breakdown, becomes an area that bearish traders could look to target on the downside on any momentum-based move here in Netflix in the near term.
Yeah, that speaks actually exactly to our example trade today. So appreciate that setup, Kevin. And now as we do look to trade Netflix for example purposes, Alex, I mean, given the fact that we've seen some more pessimism, August, September, historically weaker months, leaning into a more neutral to bear strategy.
Yeah, I just think it seems that Netflix turned a corner and it's a negative one back at the end of June. It's been in a pretty consistent downtrend during that time. If you're just going with that trend, neutral to bearish, short call, vertical. Looking to go out to August 22nd. Again, no earnings to contend with for at least a few more months. Looking at the 1200, 1205 call vertical. Looking to collect $1.70 or thereabouts. If you do, that's about a 2-to-1 risk reward. You risk 330, chance to make 170, break even 1201.70. Now, the reason I selected that 1200 mark is that's sort of up in that range of that 1 month moving average as it downslopes, but you also start to get back into sort of the former lows of the move prior to that move to the all-time highs. So a little bit of supply at that level, perhaps it could hold, but really with this strategy, Jenny, you're looking for Netflix to go sideways or lower, much like it has been for the last month.
Yeah, and I will say today that still modestly hanging on. I mean, we're barely lower, about 0.1% on this session. But our next name today is definitely no stranger to some of that downside volatility, which is Tesla. Tesla has failed to enthuse time after time again, and it seems like Elon Musk has not really turned things around. But I mean, walk us through the latest with this chart, Kevin, because as we know with Tesla, when things change as far as sentiment, it can change rapidly. So we could always see things reverse here.
This one has really gone sideways for the better part of the last 4 months, though. The market's been moving and Tesla's not been participating. So what we note today is that the price action has us in the lower portion of what we've been seeing. We do have higher lows and lower highs, giving us that triangle in between everything. But we are also below all the 3 major moving averages, below the 20, below the 50, below the 200. So we don't clearly have a current trend. We've just been moving sideways, and I love to use the term meandering, and that's really what we've done here with Tesla. Haven't really made much of a move. The stock is off about 27% year to date. That's obviously not fantastic in the face of what the rest of the market's been doing. But if you're a trader, you're waiting in all likelihood for a break of one of those white lines on the chart. It's going to be a lot more instructive about an opportunity in the near term. Although my next chart, as we'll talk here in just a second, Jenny, is going to talk about a longer term view so that we don't always get mired in what's happening in the near term and kind of miss the forest for the trees.
Okay, so then give us that longer term take. And I mean, this actually is somewhat encouraging, but I guess it depends on where you would get in on Tesla, because it really depends. There's certain levels where you could say, hey, we've improved over the last several years, and you go back to 2021 and you'd say, have we really improved? I mean, we're pretty much back at levels seen 4 years ago.
Well, as always is the case, Jenny, time frame for your trading, for your investing is what matters most, right? And so if you're a longer term investor, a look at the weekly chart would at least give you some reason for optimism. You absolutely, on this 10-year weekly logarithmic scale, we have an uptrend that is clearly in place. We still have higher lows along the way. Yes, we made a higher high with the last break through that 410 ledge above us. But at the same time, we've consolidated or pulled back and have just essentially allowed time to pass without making any new big moves one way or the other. That RSI down below kind of speaking to the need for consolidation, maybe the need of a longer range trend test. That could be the 100-week moving average. That's what that light green line on the chart here represents. So it is consistent right with that long range uptrend line as well. So perhaps the 260 area of short-term potential zone of support provides traders who want to participate in a longer range opportunity, a zone where they'd feel more comfortable doing so. Right here at 303, maybe not as comfortable. You know, a 10% plus pullback in Tesla to that support could be a lot more comfortable for many investors.
Yeah, and still firmly, 38% off of its even 52-week highs, which is not even illustrating all-time highs. So we appreciate that great technical insight and all of the help there, Kevin Horner, for the technical breakdown today. And now, last but not least, as we do look to trade Tesla for example purposes, we're looking at Tesla that is down now about 4% for the week.
Yeah, I looked at buying a put calendar down kind of where it saw a bid step into the market last time it went below 300, which is sort of in that, upper 280s section on the chart. And so looking at the August 8th, that's next Friday, August 15th, the following Friday, 287.5 put calendar. Really looking for a move down to kind of 285 to 290 in that range over the next, let's call it 3, 4, 5 trading days into the end of next week. Debit of 250 means you have $250 in risk. That's a bearish strategy, make no doubts about it, but you can't overshoot. So one that is looking for a little bit of a down move, but closer to, let's call it 3 or 4%, not something like a 10, 15% decline if things really unravel next week.
Yeah, I guess next week and really the month of August, I think, will be a key test for some of these names that have already underperformed. Can we see further weakness? Will we see an improvement? I guess it all really depends on Elon Musk and if he says anything outlandish, which he's always capable of doing. But we'll leave it there for Chartmaster today. Coming up next, it's time to talk one of really the leaders of the market this year. That's Palantir, which has been somewhat unstoppable. It is lower today, over 1%, but just closed out the month of July as one of the top 10 performers in the S&P 500. So we'll dive into earnings expectations coming up next.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Get each and every angle, the whole picture. Everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360, only on Schwab Network.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Next Gen Investing. We're talking all things Palantir ahead of their earnings. Joining us is Marley Caden, of course, host for the Schwab Network. But we'll start off with Palantir winning a pretty big Army pact. I mean, walk us through this story.
It's a pretty huge contract. Yeah, they just signed a new deal with the Army. Up to $10 billion is the value on this one. What they're going to do here is to try to meet some growing warfare demands over the next decade. So as part of the deal, Palantir is going to help the military streamline efficiencies while they said they'll be preparing for threats and consolidating 75 total contracts into one full enterprise deal. That's what this does. The agreement creates what they're calling a comprehensive framework for the Army's future software and data needs that provides the government with purchasing flexibility and removes contract-related fees and procurement timelines. That's what putting those 75 total contracts into that one enterprise deal looks like. And then earlier this year with the Army, they do have another deal. They delivered the first of its 2 AI-powered systems as a part of a different $178 million contract that they have. But obviously with this one having a $10 billion price tag, a considerably larger contract, and that's over a 10-year period.
Yeah, helps to have a good relationship with probably the deepest pocketbook on the planet, which is the U.S. government and defense-related spending. But we also got a earnings event on the calendar for Palantir, kind of uniquely early in the week next week on Monday afternoon. Oftentimes some of these bigger names tend to be middle of the week, but not in the case of Palantir.
No, they're going to do a Monday after the bell. So they'll be there with expected EPS 14 cents. That'd be up 55% year over year. Revenue is looking to come in at $938.33 million, which would be up about 39% year over year. Now, they're expecting some big growth here in both government and commercial businesses, both of them expected to grow 38% each. And that commercial business is going to be a focus because, like you said, we already know the government is a big client of Palantir. But that commercial business does have a lot of room to continue growing and have accelerated growth. So a lot of eyes will be on there. Revenue has grown for the past 7 quarters for them. Operating margin has also soared. 2 years ago, they had a loss. Now they're up to 20% on a GAAP basis. So they are really improving. And, like we've talked about, Palantir is just off the charts. Year to date, up 100%. Expectations are really high. It's the top performer on the S&P 500 in 2025. So, this is a stock that's valuation is pretty stretched. Its price to sales ratio is 126. That's sky high. The next closest one I could find was Texas Pacific Land, and theirs is 31.
Yeah, that is insane. And I know that that's like the nature of Palantir. The criticism there is like, does it even matter when we see this like phenomenal momentum to the upside? And I understand that, but there are key elements of their approach that I think that with this high expectation, they could really knock it out of the park. There's still the risk of downside. Because that's right now the nature of this earnings season. So as far as the street right now, I know that Dan Ives is an enthusiast. There's a lot of bulls that still believe in this name, but is there still that skepticism regarding just the massive growth it has to put up?
There definitely is. Wedbush and Citi are 2 of the primary leaders on the bull side, which is about 32% of the analysts who cover the company. Hold, 50%, 51.6% to be exact. So it's a pretty neutral right now, and I think a lot of that has to do with the valuation being very stretched and it being very expensive. They hit an all-time high yesterday. Sell side, 16%. So a pretty mixed bag, leaning towards neutral to bullish, obviously, with it being about 84% of the analysts, but half of them are in hold or neutral. So, I think a lot of that has to do with valuation, though.
Yeah, the valuation story makes this a tough one to talk about at any given time because there's so much about this company that is seemingly so important to where things are going and the role that they're playing in that you could understand just who cares what it's worth right now. We're thinking about what it's going to be worth in 5-10 years. But traders have to think about this, I think, a little bit differently, which is this is a stock that moves around a lot, has the potential for big swings. That said, though, probably not an area, even when the government was going through the Doge cuts and things, no one really thought, hey, Palantir's contracts are going to get cut. It's kind of similar to how we think about corporate spending around cybersecurity. sort of in this big data world, I mean, companies that have the money to spend on this, that's why you're seeing commercial grow at the same pace. I mean, there's a desire to use this type of technology going forward.
There certainly is, and that government favorability has been a huge part of this bull to neutral side argument, where we're seeing it really heavily skewed in that direction because those contracts have been so consistent. They have proven to be a favorite with the current administration. They have contracts with ICE. They have contracts with multiple parts of the government, with armed forces. So a lot
international as well.
Yes, I mean, so a lot of defense contracts in place for them, but knowing they have that commercial side as well, and like the deal with the nuclear company, which we've covered widely, but now some of the new legislation also with the One Big Beautiful Bill Act favoring them as well, because they provide the infrastructure needed for a lot of the power that is favored in that bill.
Yeah, and I think you both make a great point, is that their business model right now is very focused on securing these large, multi-year contracts with government agencies, large enterprises. So that fits they have this acquire, expand, scale strategy, but it's also then reliable. It's not something that fluctuates quarter to quarter, at least you'd expect. So all that to be said.
It seems like an Amazon situation in 2010 or something, where it was like they got this spigot. They can turn the earnings power on it, and whenever they need to. They're just about domination right now and growing and growing and growing. Palantir seems to be very early stage and obviously a very different business. They're not thinking about, hey, how much money can we make? They're thinking about, how do we just get all of these contracts? Like you said, expand and conquer kind of stage, and it's super fun to watch.
It is, and that also can create volatility. And right now with the high valuation, that's, I think, the concern, as Marley mentioned. But when you think about now trading it into earnings, I do think Monday earnings events are strange. But I mean, walk us through your thinking.
Yeah, this is a tough one for that reason. It can easily move dramatically, but high volatility. Looked at selling volatility below the market, leaning into this sell-off a little bit today. Not sure how much this overall market macro move really impacts Palantir in terms of the business. And so if you think, hey, I still like Palantir, maybe I see an opportunity in this move lower today. Selling a neutral bullish put vertical. Expires the end of next week, so trying to get as close to that expiration, as close to that earnings event as possible. 146, 143. So most importantly, Jenny, risk defined. If you can collect $1, it's 2-to-1 risk reward. Break even would be 145. Now, you don't have a ton of room. It could certainly gap through that. We've seen it move more than that many percentage points several times around earnings. But if you get the direction right and you are optimistic and it moves higher, this will work as well.
Yeah, so we'll be watching those numbers, of course, next week as they report. Is there one of our largest names really in tech that still has these earnings ahead? And we'll get the rest of earnings, of course, next week, and it will still be very much in earnings season, but we'll leave it there for FOMO. Appreciate it, Marley, Caden. Coming up next, we will look at some of the Fed speak after this week's rate decision to leave rates, of course, unchanged. We'll also be diving deeper into the jobs number, as the U.S. did add 73,000 jobs. Unemployment rate also did slightly uptick.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Nicole Petalides, live from the New York Stock Exchange. Catch me on Schwab Network, available anytime, anywhere, any device, for free. Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Welcome back to Next Gen Investing. It's now time to talk all things Fed speak, as we have heard various comments from various Fed members following, of course, the Fed leaving rates unchanged on Wednesday. Joining us now is Diane King Hall, the host of Morning Movers. So, Diane, walk us through some of the commentary we've gotten post-Wednesday, as it hasn't really been an event this week with so much else going on, but I do think very important, especially today.
Yeah, rare, very vocal dissent coming from the Fed to governors, and now we know who they are. It was, as expected, Governor Michelle Bowman and Governor Christopher Waller speaking out, putting out statements this morning about their views and spelling out more details about why they dissent. And a lot of it had to do with the job market, and this was before we got the data that we got today, as you mentioned, Jenny, showing just 73,000 jobs added to the economy, which was much weaker than expected. Governor Christopher Waller saying, quote, "At the most recent Federal Open Market Committee meeting, I dissented because I concluded that cutting the policy rate by 25 basis points was the appropriate stance of policy." Bowman also saying that she dissented. She said that she dissented from the decision to maintain the target rate for the federal funds rate at its current level. Bowman saying, I, quote, "I prefer to lower the target rate for the federal funds rate by 25 basis points." So they had the same viewpoint in terms of how much they wanted to see it lowered by. They both wanted to see a 25 basis point rate cut. What Bowman said is, quote, "With economic growth slowing this year and signs of a less dynamic labor market, I saw it as appropriate to begin gradually moving our moderately restrictive policy stance toward a neutral setting." She obviously talked about the dual mandate that the Fed has, and that is, of course, their dual mandate to managing both inflation and the employment rate. And, you know, we know this is quite the balancing act, and often the data is latent in terms of fueling the direction that they choose. The challenge is they didn't have this job market data ahead of time. Christopher Waller saying that, quote, "My position does not mean I believe the FOMC should reduce the policy rate along a predetermined path. We can cut now and see how the data evolves." So both of those were the two dissenting members. That we knew there were some dissension within the ranks, and now we have clarity on who it was and why they had the viewpoints they had, guys.
No doubt about it, and there's been rumblings of whether there's a shadow Fed governor in the case of Christopher Waller kind of leading the show. Well, I think he probably won some members over after some of the data that we got this morning. Diane King Hall, appreciate it. You have a great weekend. Thanks as always for joining. Staying along those lines, we now welcome in our next guest. That is Jordan Shapiro, Senior Managing Director and Head of Financial Services for the BlackRock Group. Big number this morning. Thanks again for joining us here, Jordan. But I want to get your just sort of unfiltered response and reaction to what we got out of the non-farm payrolls report.
Thank you for having me today. And to be honest, I've come on your show and talked about much stronger labor reports over the last year. And today's numbers were a little disappointing, and the market is certainly reacting to that. But like most things in life, it's very important that we understand this labor report in a broader context of where the American economy is right now. You know, while we didn't add as many jobs as we would have hoped this month, it's important to understand, too, that the COVID recovery is starting to slow. You know, we had a lot of months of consecutive job growth that were fueled by the jobs that were lost in the 2020 to 2022 period. And the impact of that is certainly starting to slow. And there's also a lot of positives to take away from this. Layoffs remain historically low. Unemployment has been essentially steady for the last 12 months, floating between 4 and 4.2%, a level that I call a theoretical saturation of unemployment. The number of unemployed workers has stayed relatively steady over the last few months. So while we all look to interpret top-line numbers and job gains as the most positive indicator of labor market health, we really do have to look at these numbers in an annual context, in the context of a longer economic cycle, which is one that we're in currently.
Okay, so in context of the uncertainty that is surrounding all things tariffs, I mean, how did tariffs right now impact this jobs report and, of course, what we've seen from jobs just over the past several months?
And we have to speculate that the uncertainty around the tariff situation is certainly affecting private sector hiring. We have clients that are both directly impacted and indirectly impacted by tariff changes. And many of those are going to put at least a short-term pause on certain hiring decisions while we try and understand what the direction of tariffs is going forward. You'll see manufacturing, you'll see construction, you'll see consumer goods, and even some areas of financial services are going to be affected by this. But again, it's important to understand a short-term pause in hiring does not mean that there is overall weakness in the labor market. Jobs added are just that, jobs added. We need to be creating new jobs and then identifying the appropriate workers for those jobs in order for those numbers to increase. And over the last couple of months, given the broader economic uncertainty that has nothing directly to do with the labor market, we're now starting to see that impact show up, in particular with the jobs report from July and the downward revisions from the prior 2 months.
Jordan, talk to me a little bit about immigration, how that factors in. One of the things Jerome Powell talked a lot about was the balance and the unemployment rate kind of remaining in balance. Maybe you're seeing demand come down, but also supply is coming down too. How important is that to the equation?
Well, that's our biggest concern when it comes to the hourly wage market right now. What is the inflection point of hourly wage to have an unemployed worker become employed? Is it $15 an hour? Is it $20 an hour? There's a lot of economic research that needs to be conducted still so that we can arrive at a theoretical minimum wage that's going to allow us to continue to hire people into those hourly jobs. Whatever we're going to say about it, immigrant labor fuels a lot of the low-end labor economy in this country. And if we're going to remove those workers, we're going to need to replace them with domestic workers. But in order to do that, we're going to have to take a hard look at how we're paying these individuals in the context of cost of living these days, in the context of rising inflation, and arrive at a point where firms can maintain the high levels of profitability they've seen while being able to entice workers who are not currently working, who are working in other jobs, to come work in those roles. It is the low end of the labor economy that drives the numbers that we see in these reports. It's not individuals like me. It's not executives. It's not media talent. It's the hourly labor economy in this country. And if we can't price those roles appropriately, the firms that rely heavily on those hourly workers are going to have a difficult time hiring at the volume they need to maintain their business.
So, okay, last question here is how much do the revisions matter? Because seeing now the last several months being worse than thought, I mean, this is obviously scrutinized, but does this matter to the overall report, or do you somewhat disregard?
There's been discussion recently about the validity of the labor data that we've been gathering over the last year. I think it's worth mentioning that there have been both staff and budget cuts at the Bureau of Labor Statistics and the other government organizations that we rely on to collect, analyze, and report to us this economic data. Downward revisions are not uncommon. We saw the same thing last summer, and it became a very big matter politically. And then once a few months went by, we noticed that the numbers were continuing to recover. So revisions tell me that we have errors in collecting data. It doesn't necessarily indicate either bad data, and it doesn't necessarily indicate that we're misreporting the number of jobs. It's just that we need to make sure that we invest in the bureaus that collect this data that we all rely on as reporters, as economists, and as traders in this market. So is a revision a positive thing? Of course not, especially a downward revision. It's very difficult to spin that in a positive way. But if we can just look at the fact that the U.S. economy continues to add net new jobs despite a variety of economic headwinds, tariff headwinds, immigration headwinds, inflation, changing taste of the American consumer, all of these things could have an impact that could turn us from creating jobs to losing jobs. And that has not happened, and unemployment has not ticked up in any meaningful way, and wages continue to track above the level of inflation. So if you look at all of the data together, there's actually a lot of positives to be found, and I just hope that as labor economists and as the broader finance market can understand, we don't want to look at 1 or 2 months in a larger economic cycle and say, oh, there's a lot of softness in the market. Should this be an indication that the Fed may want to act at the next meeting? I absolutely think so. And I think if perhaps this economic data was available at the last Fed meeting, we may have had a rate change. But a small rate change is a great way to stimulate the hiring economy, and I do expect that in the upcoming FOMC meeting.
Well said, and we'll leave it there. Jordan Shapiro, appreciate it very much. You have a great weekend, my friend, and thanks for joining us. As always, Jordan, of course, the Senior Managing Director and Head of Financial Services for the BackRack Group. Coming up next, it's Under 30 as we're going to focus in on rocket companies. Stick around, you won't want to miss it. We'll be right back.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more, all crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Gen Investing. It's now time to discuss, hopefully, what is the brightest spot to end on here as Rocket Companies is still hanging on to an 11% move to the upside. Joining us now is George Tillis, Senior Markets Correspondent for the network. So, George, we got obviously higher second quarter sales. There were some areas of weakness, but clearly a earnings report that resonated with the street pretty well.
Yeah, I think there's, when we talk about rocket companies, I think at least a couple times, but, this is a traditional mortgage originator and lender. They've actually expanded quite aggressively through acquisitions. They bought a competitor called Mr. Cooper, and they also purchased, I think this is the last time we talked about, this company Redfin, which again helps vertically integrate now mortgage services as well as lending, real estate services, brokerage services, and now effectively they're moving into places like auto loans and even areas like solar installation financing for residential areas of the economy. I mean, this is an interesting company right now because if you look at the context of what's happening in the housing market, existing home sales, new home sales, home builders, all these areas of the housing ecosystem have been down. And rocket companies, if you look at the last at least year to date, the stock is higher quite a bit. And it's really a manifestation of a business strategy that seems to be working out altogether. And so they did report earnings. So there's a catalyst that really caused the move that we're seeing, at least today. They reported an adjusted EPS, which was 4 cents per share, besting the 3-cent estimate. But keep in mind that the estimate was actually lower still than last year at 6 cents. So it was down by 33%. But nonetheless, they did increase top line sales by over 10%, beating the estimates coming in at 1.36 versus $1.28 billion. I think the other thing to keep in mind is they actually raised their guidance for the full fiscal year. They did denote that volume actually was higher year over year by 13%, while at the same time, the acquisition synergies and strategies seem to be manifesting with the revised guidance higher. I'm looking at this company right now with earnings estimates that continue to rise going forward. So I guess my point is that irrespective of the market or irrespective, if you will, of the housing economy, which is relatively slow right now, we are seeing pockets of strength amongst individual companies just because the margin expansion through cost synergies and strategic synergies from acquisitions. And that includes competitor Mr. Cooper, which Rocket bought, but also Redfin, which actually increases the vertical integration and cost efficiencies of the combined businesses.
George, fair or unfair with 33% of the float shorted to call this meme stock or at least meme adjacent?
Honestly, Alex, I think that share float percent, I did look at that, is quite high. The thing about it is I'm just going to give you context here. I'm not saying what to do, but that's a lot of short interest right now for a company, which is expected. And this is the thing. If you look at the EPS estimates for this year, 27 cents. Think about the quarter, they reported 4 cents. So that's a meaningful increase. Next year, 2026, they are estimating 2 times this year's EPS and over 76 cents. So for what it's worth, this company seems to be growing at a reasonable price through acquisitions, enhancing margins, and the earnings estimates continue to rise going forward. So I think this is one worth watching to see if it does squeeze because, again, the financial fundamentals appear to be improving for the underlying business, irrespective of the market for lending and the housing market. You have to go with the trends and where profit growth is. And that seems to be the case for Rocket. So I can't say if it'll be a short squeeze, but it's tough to be short right now, especially when you have earnings that are growing.
Yeah, that is encouraging. And today's move has also been hugely encouraging. We've erased some of that strength, of course, on the session, but hanging on to almost an 11% gain. I appreciate it, George, for the insight today as well as all week long. We did see a substantial repricing to the downside in markets as we really kicked off the show about an hour ago, but we've since chopped around at these not session lows, but basically session lows, where we will end things here as we are now still lower in our 4 major averages. But that'll do it for Next Gen Investing for this Friday and this week. We have the watch list coming up next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 800 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Welcome to The Wrap. I'm Jenny Horn, here to take you through today's top market movers, standout headlines, and the sharpest takes from the Schwab Network team. If it moved the market, we've got you covered over the next hour. Let's get into it.
Welcome back. You just heard the closing bells there to close out this week on Wall Street. We finished in the red in a sell-off scenario here. The S&P sold off 1.6% to close at 6238.01. The Nasdaq 100 sold off about 2%, 22,763.31. The Dow down about 1.25% to close the day at 43,588.58. And the Russell 2000, our big laggard on the day, down 2%, more than 2%, at 2166.78. Now I'd like to bring in our closing panel here. That's Alex Coffey, our senior equity contributor and the host of Next Gen Investing, and Jeff Pierce, our senior manager of derivatives trading over at Charles Schwab. I want to start with some breaking news that's just coming in. Federal Reserve Governor Adriana Kugler has just announced that she is stepping down from her role at the central bank. So there will be now a vacancy for one of the Fed governor roles who decides the rate cuts. She did not cite a reason in her resignation letter to the president, only stating that she'll be returning to Georgetown as a professor in the fall. So very interesting timing. For some background, she was a Biden nominee and of late has expressed generally hawkish views in support of holding rates steady until we had more information on tariffs. So there is a vacancy now. You know, Alex, to you first. What are your thoughts here as we're in a very what seems important and divisive time when it comes to the FOMC, that now there's a vacancy?
Yeah, it probably gives the opportunity, depending on how long it takes to get someone in the spot, I guess, to be a little bit more aligned with rates going lower, assuming the president is able to nominate someone that, you know, does kind of have those views that he seems to share, which are lower rates. Now, might not even need that, though. I mean, the jobs data that we're going to get through today, I think, did a little bit to help that cause as well today.
Yeah, it certainly did. You know, and Jeff, let's come over to you here to talk about some of that jobs data. Really surprising number. I think it, you know, certainly did not echo what Jerome Powell said in his press conference on Wednesday. You know, what were your thoughts when the numbers came out and the revisions?
Yeah, I mean, I agree. I mean, I think you could change the board up as needed, but the pressure put on from those job numbers, I think, has the Fed in a specific spot. I mean, you know, we saw that FedWatch CME tool rise quite a bit for the September. In the background, of course, we still have the president calling for the Fed to cut rates, and we've seen some dissent from the group in the last meeting. I think, you know, the dual mandate part of this story is really, really back in play. Investors are going to be focused heavily on inflation and heavily on jobs now, and tariffs, which have kind of taken a backseat a little bit to the earnings story, is very much going to be a big part of the market movement over the, you know, the near-term future.
And interestingly, you know, we've all been watching the FedWatch tool to look at the probabilities of that cut in September, and they've whipsawed basically from Wednesday to now. Just since the announcement of the new vacancy from the Fed governors, it is now a 93.7% chance of a rate cut in September. That's how high up it's gone. You know, Alex, what is the numbers today, you know, expressed to you? Someone said earlier, we don't actually have to wait until September for a rate cut. I don't think that happens regularly, but do you think there's any chance we see one in advance?
If you got 5 days next week that look like, you know, late March, early April, or escalating from today, that might be on the table in terms of equity performance. But they're not going to come out and just completely flip the cards over. I think that their plan all along, and I've stood by this, was to set things up using Jackson Hole, whether that meant pausing or, you know, a rate cut. I do think the rate cut's probably more likely. Look, the job market's still growing. Labor market is relatively in balance, but you can't argue with the trend in terms of where things are going. It's clearly slowing. I think this has been Christopher Waller's argument. If you were on the fence and say you end up signing the sheet, you're one of these Fed governors that isn't Powell, isn't Waller, isn't Bowman, and you're trying to figure, you know, I'll side with Powell this time, but I'm teetering. I mean, Waller's looks more right today than Powell does. And so more data supports this through ISM next week and the jobs data in August, and then the jobs data, well, that'll be the next time we get data, will be the, you know, August report that we get in early September. it's going to be hard not to cut rates. It's already the one thing that isn't in line when you look at 2-year treasuries, 5-year treasuries, 10-year treasuries, 30 years. That's a normal sloping treasury curve. The Fed funds is way up high. That's the one thing that isn't in line.
And Jeff, coming to you, the jobs wasn't the only data that we got today. We did get consumer sentiment. We got ISM numbers. What were some of your takeaways from those?
Yeah, again, I mean, we're watching consumer sentiment, improve slightly, still down from a year ago. And inflation expectations really fell in the 1 to 5 year number range, which was good. And both of those are seeing some of the lowest readings we've seen since February. So the soft data is kind of moving its way up. Whether the hard data follows is really to be seen. I mean, the manufacturing story is very interesting because, we watched ISM manufacturing nudge lower. Down about a point, coming below estimates. That's, this is the 5th straight month of contraction territory for that. Employment index fell further as we saw, supply deliveries, prices, back orders, all in the wrong side of things. S&P U.S. manufacturing PMI also revised slightly higher, but again, remains some of the lowest readings we've seen since December. You take that with some of the manufacturing data we've seen in the past week or so and what we're going to see next week. And I think that there's a lot that, investors have to pay attention to on that front as we watch inflation put pressure on manufacturing.
And Alex, it was a huge week of earnings. You were here with us to cover most of them. What were some of your key takeaways?
Key takeaways was, I guess, if you combine this into looking ahead to next week, is you don't have Meta and Microsoft next week to save this market. So it was a market that over the last month, as we kind of wrapped July as well, and we turned the page to August, in the context, allowed for names like Meta and Microsoft to outperform. It allowed for a name we're going to get on Monday in Palantir to outperform and shine because the macro wasn't in the way. We watched how quickly you can forget the fact that Microsoft had almost 40% Azure growth. And you look at Amazon, they had 17% cloud growth for AWS. It's a really impressive number. The e-commerce numbers were really nice. We talked about yesterday, Apple, huge beat for iPhone. China swung to a growth. It beat expectations, yet the stock's down 2.5% because macro market forces took over. So earnings were nice for some of those big important names, but if anything, they just brunted the blow here a little bit. They were overtaken completely by some of these other topics.
And Jeff, for you, knowing that now we've done 6 of the 7 in the Mag 7, and now we're, coming into the remainder of earnings season and still have a ways out for NVIDIA, what were some of your key takeaways and sort of what are your expectations going forward?
Yeah, well, that Mag 7, I mean, the expectations were high. We saw a lot of decent data come out of the Mag 7. I think the expectation side of things, especially considering how much money some of those names have been spending lately, were some really impressive reports. As we go into next week, obviously, Palantir, AMD, names like that are certainly individually names that people are going to pay attention to. CAT also will be an interesting one to focus on from an economic standpoint. A lot of people look at that company in that way. Going forward, next week is not as big of a week on the earnings side, which does give investors a little bit more time to focus on economic data, which we do have a fair amount coming out next week. And I think investors are going to be paying a lot more close attention to those points.
And Jeff, staying with you in terms of the data that's coming out, what are you keeping the closest eye on?
Yeah, on the manufacturing side, again, looking at factory orders coming out Monday, that prior report, we saw a pretty big jump in factory orders, a jump about 8.2% from the prior month. But of course, trade deficit, the U.S. PMI final from S&P, I'll certainly be focusing on the service side there. That's really been the leader and one of the most important parts of that report. Productivity, consumer credit. They're all going to be, very important. And again, investors this last couple weeks, really focusing on earnings, maybe pushing a little bit away from data. And this, today put them back on the data track.
It certainly did. And Alex, we've talked about Palantir already today and their earnings on Monday, and an abnormal day to not be midweek. Outside of Palantir, who are you most interested in seeing report?
Yeah, I think that there's plenty of names when you look at the calendar, whether it's an AppLovin, whether it's an Uber, some of these, but they're not going to move the market. They're going to be idiosyncratic stories. Reddit's a perfect example of this. Reddit's had a really nice day today, despite all the things we're talking about. So if you're an investor in some of those names, being aware that they're on the calendar, but if you're just a macro or just have a stock portfolio or you're tracking an index, there's nothing on the calendar from an earnings standpoint to save the market next week. That'd be the only concern. And then, to Jeff's point, ISM Services is must-see TV next week. I would go to say, absent something out of the administration that surprises, Tuesday morning at 9 Central, 10 Eastern, that's going to be the moment next week that I think is the determining factor of where we go.
All right, that's our linchpin. Well, thank you, Alex Coffey. We appreciate you being in studio. Jeff Pierce, thank you for joining us remotely. We appreciate it.
He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Welcome back to The Wrap, where we take you through the best interviews on Schwab Network. Let's head back to New York for the Big Three.
Time now for the Big Three. 3 stocks, 3 charts, and 3 trades. Kevin Horner will take us through the charts, and here to take us through the trades is Scott Bauer, CEO of Prosper Trading Academy. All right, Scott, you've got diverse picks on your list today. The first one on your list today, you've got Chewy. It's under some pressure today, but it's actually got a gain so far year to date. But over the past several years, it's had a bumpy road. So when you think about this now, where do you go from here?
Well, they have earnings at the end of the month, so I don't want to take that into consideration. But when I look at the chart here, the 200-day moving average, that has been tremendous support. So I'm looking squarely at that, and we are right at that 200-day moving average. So this is a real quick trade that I'm looking at, not a day trade, but just going out a couple weeks here. I'm just buying the August 15th expiration 36 strike calls for $1. Again, the only reason I'm doing this is because of that massive support there. I don't want to have anything involved with earnings later in the month. And Diane, in general, people look for or they say, I'm waiting for a pullback. I'm waiting for a pullback. And on a day like this, when we get a pullback and you see a significant one, albeit it's just one day, people get hesitant. All of a sudden what they've been waiting for maybe is here now, and they just pull back a little bit. To me, opportunity, and that's why I'm doing this.
Okay, all right. So, Kevin, all right, tell us then what you notice about the patterns in this chart. I mean, I noticed that Scott is avoiding earnings risk, but what are the levels you notice?
Yeah, same things that Scott's calling out here. The 200-day moving average is quite notable. In fact, the last two times on the daily one-year chart, we're going to see moves off the 200-day that resulted in at least 60% upside maneuvers before the retreat and pullback to support. If we go back to basically the very beginning of this chart, about a year ago, we tested the 200-day and moved upward over the course of about 6 weeks, made a 60% move before we pulled back and got below the 50-day. Here, we tested most recently the 200 in April off of the April lows at around 30 and pushed that all the way to the highs we see at around 48. That was a 61% maneuver. Now we are 25% off that peak, hitting the 200-day moving average, but you'll notice we haven't gone anywhere for the entirety of the last week. We are getting a little bit of a green candle today at that 200-day moving average. If nothing else, I think it makes sense to validate that 200-day based on what we've seen in this one-year trend. And as Scott pointed out, for traders who were thinking, hey, if I got a shot at the 200-day, I should be ready to go, it's harder to do that in the moment, isn't it? I mean, it's always fun to say, yeah, I'd love to be buyer here, but when we get that opportunity, doesn't mean we're ready to go.
All right, Scott, let's talk about your next trade. Like I said, it's a diverse list today. So First Solar is on your list today. The company just put out earnings. They beat expectations. The stock is higher today, but it's, the whole solar space has been challenged recently because of changes that are coming in that sector. But what's your view on, and what's your approach to where you take this next?
Yeah, solar has been one of the more volatile sectors that we've seen because it's in the news quite a bit. We've seen rallies, then we see the administration come out with some news that has maybe hit these stocks. So when I look at First Solar, I think this is an opportunity on this run up here to sell the rip or fade this. And I say that because we're coming up to some major resistance after this nice move up because of earnings. So what I'm doing is I'm going out to the end of the month, August 29th expiration, and I'm just buying a simple put spread, the 170, 160 put spread for $2. And it's really for no other reason than the solar industry, the solar sector, if you will, has just been all over the place. And because of that resistance up there, I'm looking for a bit of a retracement.
Okay, all right, Kevin. Now, what do you notice about this chart for First Solar, especially that resistance that Scott mentions?
Yeah, I was seeing the same thing. Right when 189 was the level we hit intraday today and have pulled back. The interesting thing to me is that support at 165. You got approximately the 50 and 200 ready to cross to the upside, which could be bullish in the intermediate window. But given the shorter term nature of the potential for banging our head on that 189 ledge and maybe reversing course here, I could understand the bearish sentiment or the bearishness willing to trade that directionally. And the RSI is not exactly validating the recent price move into that 189 either. So the bearishness in the short term makes sense, but pay attention to that 165. That volume node there at the volume point of control, consistent with that 5200, does seem to provide a fair bit of support at 165.
Okay, Scott, I want to send it back to you. You said this is really an opportunity to sell the rip. Tell us a little bit more about how this plays out.
Yeah, I agree exactly with what Kevin just said. You look at that area right there, 165, and you see that is almost a golden cross area where the 50-day moving average might be moving above the 200. So that's actually my target to the downside. Even though my put spread is the 170, 160, boy, if we get a pullback to that area, even 170-ish or so, this put spread's going to explode. So if we get that pullback, I'm in agreement. I'm taking that thing off there because that could be a pivot to turn back higher.
Okay, so let's talk about the last one on your list. You've got nano-nuclear energy on your list. This one is lower today. I'm curious to know, I'm wondering, because I didn't see your full thoughts on this, if this is a buy the dip opportunity, but you tell me, Scott.
Yes, nuclear has been another big sector in the news, and these stocks have been very, very volatile. And yes, to me, me, it's a buy the dip, but it's a buy the dip because there's some really, really big support right in this area, the 36-ish level or so. So when I look at NNE, it's a bit riskier because they do have earnings on the 14th. So I'm using the August 15th options on this one here. I'm just buying a simple call spread, the 35.40 call spread for $1.10. Great reward to risk on that. My intent would be not to hold this through earnings. So if we get a bounce off of this support area here, I would look to exit this prior to earnings.
Okay, so you are trying to avoid the earnings risk there. All right, Kevin, take us through what you noticed about this chart for nano-nuclear energy. I know overall it's been an outperformer. It's got some weakness today, but there's broad weakness in the market today.
Yeah, I think that test at the 33 level today, the intraday low comes in at 33.22. And, you know, the last time we were down here, we had this beautiful hammer candle that I put the other oval on. So this looks like a very strong zone of support. Under this, certainly some more weakness. But the other thing that really stood out on this chart to me is that very large volume node. Now, it's not the volume point of control, as we call out with the red line down below around 2560, but the range here is notable. And I feel like there's an opportunity for the stock to be kind of stuck 33 to the top of that volume node around 38. It's going to take some pressure to push through that. There is a lot of historical volume at this spot, and it would not shock me at all to see some sideways movement between that 33 and 38 zone over the coming weeks in advance of earnings.
All right, Scott, I want to yield the floor back to you for a final thought either on nano-nuclear energy or the broad-based market action that we're seeing today. We are seeing weakness. There are triggers for this, obviously. It's changes on the trade front. And then, of course, we've got that weaker than expected jobs report. You did talk recently not just about, you know, some of the patterns where you've seen if there's weakness, you're buying on that weakness. Tell me about your take now where things stand. And how you view
Sure.
it.
So we've had this discussion before, and I'm going to speak as a trader because that is what I am. And this is a perfect lesson, what we are seeing in the market today, of why you buy your protection when you can and not when you have to. When the VIX is depressed and trading 15-ish, or when overall volatility is depressed as it has been in the S&Ps, the Qs, et cetera, that's the opportunity to buy that protection. And that is what I teach my students. That is how I trade. So this is a great lesson for anybody watching today, that you never know what to expect. We can't be too complacent. You buy when you can and not when you have to. And that gives you the opportunity then to trade when something happens like this, rather than feeling scared or handcuffed like you can't do anything. Overall, you know what? This is probably more of a one-off for now, this big decline today. That being said, I think we are starting to see some cracks in the economy.
Okay, yep, it certainly seems evident by both the jobs report and that latest ISM data that we got this morning that showed more weakness in the manufacturing sector. All right, Scott, thank you. That's Scott Bauer, CEO of Prosper Trading Academy, and Kevin Horner, Senior Manager of Trading Services, Charles Schwab. Thank you, guys. Have a great weekend. Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 800 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Welcome back to The Wrap. I'm Jenny Horn here in our Chicago studios. Let's keep the show rolling with what you need to know about today's trading session.
Welcome back to Market on Close. I'm Marley Caden. It's time to dive now into some of the mega cap tech earnings that we've gotten so far this week. Joining us to discuss them is Daniel Rubino, the editor-in-chief of Windows Central. Now, Daniel, thank you for being with us this afternoon. I'd love to start just with some key takeaways you had from the Mag 7 earnings that we've gotten so far.
Yeah, it's been a pretty big week, lots of ups and downs, but for the most part, AI is the big story, as you guys were just discussing, and it's driving some real positive growth and real momentum. Microsoft came out on top, in my opinion, crossing that 4 trillion metric, which was a pretty big deal. They're also, going to the consumer market, they have enterprise, and they're kind of really well positioned for where AI is headed. I will say Apple had a very interesting quarter. Their sales were much higher for iPhone, Mac, and services, and this is all great. However, I am a little concerned about those numbers because I'm wondering how much of it was driven by fears that the tariffs are going to drastically increase prices. We did hear a lot of stories of iPhones costing $2,000 and such. So, the price will go up on the new iPhones coming out. The rumors have it around $50, but we'll have to see how Apple can navigate that. I think the bigger story with Apple, though, is the fact that, when it comes to AI, they don't have much of a story right now. They're behind the scenes trying to catch up to everyone. And while it may not seem like a big deal, obviously the stock reacted to that in a negative way by kind of punishing them despite beating expectations in all the other areas. iPads and wearables also went down. That's been a trend for the last few years, and I expect that to continue. When it comes to Samsung, although they didn't report their earnings, they had a big week too because for the first time, their foldable phones seem to be catching on with consumers. This has been a struggle for them. They're literally on the 7th version, 6 years of making these devices, but their sales have been exceptional for them, up 50%, up 60% in the United States, I should mention too. And they did that while increasing the price. Their Fold 7 is now $1,999, where 2 years ago, the Fold was $1,799. So a $200 increase, and yet they're still doing well. So there seems to be a lot of momentum in that area. We expect Apple, of course, to jump in on foldables soon as well.
Oh, that was about to be my question to you. We've certainly heard those reports that a foldable phone may be coming Corning may be working on supplying the glass. There's all these reports about the potential of this. Do you think that in conjunction with the iPhone sales, which you think is a tariff effect, in fact, that people tried to get out ahead of that, is that going to be enough to give Apple another boost until they really decide how and where they're going to enter this AI race?
It might. There'll definitely be a lot of publicity around it. There'll be a lot of hype, and I have faith in the company. It'll be a really good product. The problem is it's going to be very expensive. And iPhones typically are already expensive, though they've been doing a good job, I would say, in the last few years of bringing down the price by reselling their older models. But the issue here is, and they know this, which is why they've been slow coming to the foldable market, besides the technological challenges, is that this is totally going to cannibalize iPad sales. Because when you're able to put basically a foldable tablet into your pocket, you may not need an iPad as much as you did before. So I think that's one reason why they've been hesitant to do this. So the iPad sales already decline is already like a good sign for them in the sense that they can jump in on that. So this might offset those numbers. I'm not sure if it's going to completely save them. They did have the issues with Vision Pro, of course, as well. But, you know, their service is very strong with Apple TV. They just did that movie F1 this summer, which was a huge hit for them. And Mac sales seem to be pretty steady. Again, they were up this quarter, which may be a tariff effect, but they've been well received, especially the M4 chip. So I expect that to continue.
And you mentioned the tariff impact potentially being why we did see that surprise uptick in the iPhones. We didn't get a lot of commentary, mostly because the tariff frameworks aren't done. I think they were protected that they didn't have to give it. But how much impact in this coming quarter do you think we could potentially see as they, work to pivot their supply chain with their exposure in China and Vietnam and some of these places that have 20% plus tariffs where they bring parts in from?
Yeah, it's definitely going to be a big challenge. They are obviously launching a new product in the fall. It'll be the new iPhone 17. And, how they can control those costs is going to be difficult. Like I said, we're expecting, the rumor is, a $50 increase, but Samsung's been increasing by $100 on some of their devices, as I just mentioned. So, I wouldn't rule that out either. So those costs will definitely be passed on. It won't be as dramatic as a $2,000 iPhone unless you get the super high-end one. But I do expect the prices to go up. But where the market is right now, there's so much in flux here. How China reacts to things obviously is going to be a big part of this, as well as the Trump administration.
Certainly. Now, I do want to pivot to Microsoft, too. You had mentioned them earlier. They've hit that $4 trillion market cap, now only the second company to do that behind NVIDIA. What were your thoughts there? Because sort of a very opposite story here. They're very clear in their AI spending and where they plan to be in the AI race.
Yeah, it's funny. I got my start covering Microsoft consumer tech, which we still do cover, things like Xbox and laptops. But they've really pulled back in the consumer segment for the last couple of years because Apple and, of course, Google is there and Samsung. But they've been, putting a lot of money into what they used to call, and they still call it intelligent cloud. That was the big subdivision, and then Azure was a part of that. Now they, for the first time, broke out Azure numbers, which is really interesting. Now, the other companies already do this, but it goes to show you how much confidence Microsoft has in their cloud and AI infrastructure. They expect positive growth to continue. They outpaced growth this quarter compared to Amazon, which is why, Amazon's stock went down a little bit. So Amazon's still the number one when it comes to cloud compute, but Microsoft is right there and gaining more customers faster. They're obviously building out as much computing power as they can for this AI infrastructure, because the faster you do that, the more power you have, the lower you can bring down the cost. They are expecting enterprise to adopt Copilot more in the coming year, which will, of course, drive up the demand for AI. The question is, how much can they bring down costs? And whether or not we're going to have any major advancements in AI that could really change things. China came out there and was supposedly able to train their models without using as much sophisticated hardware as the US is. If something like that happens here, it could change the dynamic of, this CapEx that's kind of through the roof for all these companies in terms of spending for AI.
And so you mentioned, you started your career covering some of their consumer products. That demand is softening for them. What do you think the pivot looks like for them to make that a bigger growth sector?
It's really tough. I keep telling people right now is the best time to buy a